Hi, everybody. Tom Gile with the Gile Group. Hey, bringing you some breaking news here in the special edition of the Gile Report. We've been hearing a lot of gloom and doom here in the headlines over the last month or so. I want to bring you some good news today. It's always great to hear some good news. So, taking a look at the July employment numbers, they just came out yesterday. The economy picked up 1.8 million jobs in July, which with some of the biggest gains coming in the entertainment and hospitality sectors, along with retail, some of the areas that have been hardest hit as the economy slowed down in April and May. How does that translate into unemployment? So let's take a look at this. Looking at the July unemployment rate, it continues to drop. It's at 10.2%, down from 11% in June and down from a high of 14.7% in April. So we're seeing some steady declines here in the unemployment rate as people are getting back to work here in the United States. Let's take this one step further and really dig into what that employment rate means, or what the unemployment rate means. So taking a look at it, 10.2% people unemployed right now. It's about 90% people are still employed. Obviously, 10 is a number that we definitely would like to see get back down to more of a normal level. But also note that when you adjust, is it a permanent type of unemployment or is it a temporary type of situation? So if we're looking at July, for example, about 9.2% of the people that are unemployed are considered to be a temporary situation, which they should be coming back to work here in the next several months. So that's, breaking it down. Obviously, 10 is a big number, but it looks like, as the economy continues to rebound, we're going to expect that number to rapidly improve to get us back down to where we're at earlier in the year. Last week, we did a deep dive into the gross domestic product report from Q2. And what I want to do today is take a look at how the experts predicted Q2 versus how it actually happened. And then let's take a look at what the projections are for Q3. So this graph does a good job of showing what the projections were from a number of economic experts from Goldman Sachs, Morgan Stanley, Bank of America, Wells Fargo, and JP Morgan. They were predicting on average that we'd see a 31% decline in gross domestic product in Q2. They about nailed it on the head. We actually saw a 32% as opposed to 31%, so the projections were spot on. So now let's kind of extrapolate that, let's move forward and look at what these experts, along with some others, are saying with what we can expect for Q3. So looking at these same experts that we looked at, plus some additional ones over here in the blue, we're seeing anywhere from projections of 15% improvement in GDP up to about 25% improvement in GDP. All the experts are in agreement here. We're expecting a pretty strong rebound in Q3 and Q4 as we move forward. A great quote here just really sums it up here is from Lisa Shallett of Morgan Stanley. She says, "Indeed, the worst ever GDP recorded could be could be followed by the best ever growth in the third quarter." So that's what I think we have to look forward to, which I think is great news for everyone, and we're going to be watching this closely. Switching gears here, let's talk about home prices, how this all equates into the housing market. Here's a quote from Quicken Loans. It says, "The pandemic has not stopped the consistent home price growth we've witnessed in the recent years, and we are definitely seeing this here in the Portland area, as if you've been watching our reports here over the last couple of months, seeing it here in Portland and really seeing it across the nation, just really strong home prices." Let's take a look at this graph here. It's projections moving forward. So let's break out the crystal ball. A number of financial analysts are taking a look at where they expect home prices to go in the next 12 months. And take a look at these numbers because they are different than what we saw a couple of months ago. Typically ranging from about 2.3% growth to 4.4% growth overall appreciation in the next 12 months. We've got a core fact and one other company, House, showing a slight decline. They're projecting about a 1% decline. These numbers, if you compare these to what we saw about 2-3 months ago, are definitely up because we were seeing at the time projections, modest gains of about 2.5%. So we're seeing some creeping up here as the economists are taking into effect what we've been seeing the housing market do over the last several months. And a lot of that is being fueled by the mortgage rates. So obviously, we're going to wrap up this session here talking about what's going on for mortgage rates. And the interesting fact is this came out this week on Thursday from Freddie Mac. We hit yet another all-time low with a 30-year fixed rate at about 2.88, a 15-year fixed rate at about 2.44. Pretty incredible rates right now. If you haven't refinanced your house, I recommend you go refinance your house. If you're looking for a house, this is definitely giving you some additional buying power when you're out there looking. So some great news on the mortgage front here. And that's going to wrap up where we're at with this report. So let's take a look at the bottom line of what we talked about here today. Just remember, and I've been saying this for months now, this is a great way to put it. I heard it this morning. Headlines are meant to terrify, not to clarify. The headlines out there are going to trying to shock you. So make sure that you base your decisions on sound information. Employment continues to improve. We added 1.8 million jobs in July. The Q2 GDP estimates were spot on, as we just saw today. Q3 outlook projections are showing a strong rebound, leading to that V-shaped curve we've been talking about. Housing prices and the housing market continues to lead the way out of this pandemic and economic situation that we're in. Interest rates reached another record low this week. It's the 8th record low this year. So if you have any questions about the economy or the real estate market, ask the Gile Group. We're here for you. You can email us at askgilegroup.com. askgilegroup@gilegroup.com. You can check us out on social media, both Facebook and Instagram. Obviously, you can also pick up that thing that you normally text people on. You can give us a call. We'd love to talk to you.